Good morning or afternoon or evening, depending on when you're watching this. This chapter 20, is all about taxes. So, pretty exciting stuff. We're all going to have to pay taxes at some point, so pretty relevant and practical. So, we're going to start with just some basic sales and excise tax. So, you're probably familiar with sales tax, maybe not as much with excise tax, but these taxes are extra amounts that a business collects and later pays to the state. So these are state sales taxes specifically. Local taxes may apply in addition to state taxes. So the state has a set tax amount, and then each city may also instate their own addition to that. Some states charge no tax on food or medicine, and some of you may live in those states, which is really nice. Even some cities, there is no sales tax, I've noticed, on grocery items or various things like that. Laws vary, but some purchases made in one state and delivered in another don't include taxes, so depending on where you're buying it. Some things may be tax exempt. So some key words: tax is just money collected by the government for its support and for providing services to the populace. Sales tax is a tax based on the price of a purchase. It's collected at the time of the purchase, and the business periodically sends it to the government. Okay, an excise tax. So you may not have heard of this, but it's an additional tax levied on the sale or importation of goods for the purpose of raising revenue or discouraging a particular behavior. So it's often called a luxury tax. And it's collected from things like fuel, airline tickets, tobacco, alcohol, other health-related goods and services. So when it says here, it's some of the purposes to discourage a particular behavior. They may want to discourage people from buying tobacco and alcohol, so they're going to tax it more than they would tax normal items. Okay, so the way you find the amount of tax you need to pay is pretty straightforward. It's just like the percentages that we've been talking about. The sales tax rate will be given to us a percent, so you'll convert it to a decimal, and then you'll just multiply it by the purchase price. For those of you who live in Arizona, just thought it was kind of interesting to look at some of the cities, the popular cities. These are the most inhabited cities in the state, and their different sales taxes. So you'll notice that Phoenix is 8.6%. Glendale, which is really close to Phoenix, it's part of the Phoenix area, is even higher than that, 9.2%, and Buckeye's even higher than that. So one thing I want you to notice, whether you're in Arizona or not, is that Arizona, the actual state sales tax is only 5.6%. Yet you see here that these are all more than 5.6%. So then Maricopa County, which is where our school is located, has an additional 0.7%. So that takes us up to 6.3%. And then the cities will tack on their own sales tax as well. So you don't end up paying just the state sales tax when you pay sales tax. You pay the city and the county tax as well. For various states, the highest sales tax in the country by state, so if you want to guess, you can, but I won't know what you're guessing, so a little game you can play with yourself. Tennessee has the highest, and then Arkansas, Louisiana, Washington, and Alabama. So I'm sorry if you come from one of those states. That's just the state tax. So it could be even higher depending on the city tax. There are some states with no sales tax. You may be able to guess what those are. But they are Delaware, New Hampshire, Montana, and Oregon. So if you want to move somewhere with no sales tax, there you go. The lowest sales tax, other than those four which have no sales tax, would be Alaska, only 1.69%, Hawaii, Wisconsin, and Wyoming. Oh, and Maine. So, yay, if you live in one of those states, you won't have to pay as much. Okay, so let's do some calculations here. What is the sales tax on these headphones if the sales tax is 8.1% in Tempe? Tempe is where UAT is located. So you'll see that the headphones are $179. So all I have to do is figure out 8.1% of $179. So I'm going to multiply 179 times this percentage, but remember, whenever we use a percentage in our calculations, we have to convert it to a decimal. So I'm going to move this decimal over twice to the right, giving me 0.081. So 0.081 is going to get multiplied by 179. And when I do that, I get 14 point, and it says 499. So since I'm doing money, I want to round to 2 decimal places. So looking here, if I look to the right, it's higher than 5, so I'm going to round this up. So it ends up being $14.50. So that's how much I'm going to pay in tax. Now, if you wanted to know how much these headphones are going to cost you, you would add that to the $179, but that's just the tax. Okay, so this is just kind of interesting, the sales taxes in the different states. So you can kind of look at this map and find your state. So, and it has them ranked in number order. So like Arizona, we're number 11. Okay, find the excise tax. So that's the luxury tax, that additional tax on like gas and alcohol, tobacco, etc. On a $45.93 purchase of gasoline, where the excise tax rate is 27.1%. Yikes. So I'm going to do the same exact process I just did for sales tax. It's $45.93 times the amount of tax, which if you move the decimal over twice makes this 0.271. And then you can just plug that into your calculator, $45.93 times 0.271, and you get $12.45 when you round up. So that's how much the tax would be. So that's how much you're paying in addition to the $45.93. Okay, this is about Arizona, which I know a lot of you aren't from Arizona, so we can move ahead. The marked and total price. And the marked price is the purchase price before sales tax is added. So that's like when you see something on a hanger, that's the price you think it's going to be, but it doesn't end up being that when it's all said and done, because you have to pay sales tax. And so when you pay sales tax, that gives you the total price. So let's say I have the total price and I want to figure out the marked price and the sales tax. So I'm going to walk you through an example here. So let's say the ticket to the new Lego movie you saw last night, oh, it's not new anymore, cost $8.50 and included the tax. So they charged you $8.50, but there was some tax in there as well. So if this local sales tax is 7%, what was the marked price of your ticket? So if you look back at what to do, you're going to first take the sales tax rate as a decimal equivalent. So ours was 7%, which is going to be 0.07. That's a decimal equivalent. And then I'm going to add 1 to it. So it's going to be 1.07. The reason I'm doing that is because if I go from one price to the next, it's increasing once I add the sales tax, right? So if it's increasing by 7%, it's going up 7%, which is basically taking the old price, which was 100%, plus 7 more percent. So it's really going to be 107% of the original amount is what the new amount will be. Because 100% is what I had before, plus 7 more percent. Okay, so then I'm going to take the total price, which in our case was $8.50, and I'm going to divide it by that 1 plus the sales tax rate, so by that 1.07. That's going to give me the marked price, so the price that it was before tax. So if I do that, $8.50 divided by 1.07 is $7.94. So that is the marked price of the movie ticket. So notice they don't usually tell you that, like, oh, this movie's going to cost $7.94. They just build it into the price. But that was what it was worth. And then sales tax made it $8.50. So what is the sales tax? Well, if the marked price was $7.94 and the total price was $8.50, it's just going to be whatever the difference between those two was. So I'm just going to subtract them. And when you subtract them, you get 56 cents. So that's how much sales tax I paid. Okay, so let's look at another one. Find the marked price and sales tax on a box of popcorn, which has a total price of $3.50. It's actually probably cheap, huh? The local tax rate is 6% in this case. Okay, so you're going to take the marked price and you're going to divide it by basically 106%, which is 1.06. Okay, so when you do that, when you take 350 and divide by 1.06, you get 3.30, so $3.30. So that's what it originally was before you added tax. So that's the marked price. And then the tax is going to be the 350 minus 330. So that's how much it went up, which is 20 cents. Okay, for the next one, you'll do the same process. Find the marked price and sales tax. So the total price was $2.50, and the local tax rate is 6.5%. So I'm basically going to be dividing by 106.5%, right? Which, if you move the decimal over twice, is 1.065. Okay, when I do that, 2.5 divided by 1.065, I get $2.35. So that's the marked price. Oh, forgot the R. And then the sales tax is going to be $2.50 minus $2.34, or $2.35, I'm sorry, which is 15 cents. All right. Some interesting taxes you may be interested in reading about. Alabama has a 10-cent tax on a deck of playing cards. Blueberries from Maine are subject to a tax of 1.5 cents per pound sold. New York levies an 8-cent tax on each sliced or toasted bagels. So there's an additional 8 cents tax. Peter the Great in Russia once taxed beards. Huh? Illinois has a 5% tax on candy on top of the 1% food tax. But Illinois considers candy with flour as an ingredient to be just an ordinary food. So if you're buying a Kit Kat bar, you don't have to pay the candy tax because it contains flour. M&M's though, sorry. So just stick to Kit Kats and Snickers and things like that. That's the loophole. Also, turning 100 gets you exempt from state taxes in some states, which is kind of cool. So something to look forward to. And in Arkansas, they charge 6% to get tattoos, body piercings, and electrolysis. Okay, so that's section 20-1. This is section 20-2. This is looking at assessed value and property tax. So the expected selling price of a property is considered the market value, how much they think it's going to go for. And then the assessed value is a specific percent of the estimated market value of the property. Now you'll notice down here there's a little note here. Assessed value is not like the appraisal value. A lot of people get those confused. Assessed value, really, you don't really need to know the assessed value of a property. It's basically used for cities to determine property taxes. So home buyers and sellers look more at the market value. So the assessed value really doesn't mean a whole lot to you in buying a home. It's more just to help figure out property taxes. Property taxes are taxes collected by the county, municipality, or local governments from the property owners. So some people, you may hear that they're going to move to a certain city because the property taxes are low. So there's a tax you're going to have to pay every year based on where you live if you own a home, and those are the property taxes. It's based on the type of property, the value of the property, all of those factors. So to find the assessed value for tax purposes, as always, if the rate is written as a percent, you're going to convert it to a decimal. And then you're just going to take the assessment rate once you've converted it to a decimal and multiply it by the market value. And that will give you the assessed value. So find the assessed value of Dwight Schrute's Beet Farm. Any Office fans out there? With a market value of $911,000 if the assessed valuation is 25% of the market value. So all you're going to do is take 911,000 times 25% as a decimal, so move it over twice, so times 0.25. So it's like saying a fourth of the value, right? And then you'll just multiply 911,000 times 0.25, and you get $227,750. So that's considered the assessed value, which really doesn't mean much to you as the property owner, or to Drute, I should say. Drute, that's Dwight and Schrute combined. Okay, or to Dwight, but for property tax purposes, it's going to be an important number. Okay. Property tax. So there's a couple different ways, I guess a few different ways that it could be written. It could be written as a percent, which is normally what you would see it. It could be written as an amount per $1 or per $100 of the assessed value. Or it also could be in mils, which I have not seen that really ever. But it is a common value that they've used in the past. So a mil is just 1/1000th of a dollar. So that'll come in another question. Okay, so highest property taxes, in case you're curious. The average annual property tax in the U.S. was $3,296 in 2016, with an effective tax rate of 1.15%. I'm not going to do that, but the states with the highest property tax are these 10. So you'll notice New Jersey has the highest property tax nationwide. If you live in one of these other states, you probably have pretty high property taxes, relatively speaking. Okay, so to calculate property tax, you're just going to basically multiply the assessed value times the property tax rate. So you'll notice it's kind of a similar process for all of these problems. I mean, when we were doing the ones in section 20-1 with sales tax, you just multiplied the sales tax rate times the amount. Same thing here. So you'll just make sure all your percents are converted to decimals and multiply them. Okay, so find the property tax on a home with an assessed value of $310,000 if the property tax rate is, so here are some different situations. So here's a home, not too far from here, at $310,000. So property tax rate is 11.08%. So we're saying this is the assessed value, although on here it looks like it's the market value. So let's just assume that it's the assessed value. So you're just going to take 310,000 times 0.1108. And that is going to give you $34,348. So that's how much you'll pay in property tax. Okay, now this is $11.08 per $100. So the way I like to think of this is 11.08 per 100, so over 100. So that's actually going to, oops, if you actually divide that out, you would actually get this same number. But you can just do that times 310,000. So you can either divide it first and then multiply, or you can just put this all into your calculator at once. And guess what? You get 34,348. So this is another way you could express it. $11.08 for every $100. Okay, here's $110.80 for every $1,000. So when I see this per, I'm going to just basically put it over that number. So 110.80 divided by 1,000, and that's going to get multiplied by the 310,000. And guess what? This gives you the same exact thing. So this is saying the same thing as those. Okay, here's that weird word mils. So if you look back to what it meant, it's 1/1000th of a dollar. So basically this is saying per 1,000, right? Because it's 1/1000th of a dollar. So this is basically saying the same thing as the last one. It's 110.8 for every 1,000. And that's going to get multiplied by 310,000. So if it says mils, just take the number and divide by 1,000. Oh, and by the way, you get the same number. Okay. I thought this was kind of interesting. We could find the property taxes on the White House, huh? So if you go to Zillow, the White House actually does show up on here. So it's estimated at $406,526,585. So we'll just go with 406 million so that I don't have to remember this number. Okay, and the property tax rate is 85 cents for every $100. So I'm going to multiply that by 0.85 per 100. So per basically means to divide in this case. Okay, so if I divide that, let's see, 406 million. I don't know why I would have expected it to be more than 406 million. But I'm no real estate agent. And I'm sure you can't buy it. Sorry for those of you who wanted to. So you get $3,451,000. That's how much you pay in property taxes. Whew, it's a lot. Okay. So how a city determines a property tax? The city or government, the city or county government, sorry, determines how much money it's going to need for the year. So they do their budget. Usually it's at the end of the year. They figure out how much they're going to need. And then they take that amount and they divide it by the assessed value of all the property in its area. So if it's a city, they look at the assessed value of all the homes in the city, add them all together, and they take what they're going, how much money they're going to need, and divide it by the assessed value. And then that tells them how much tax they need to collect for each dollar of the assessed value so that they can pay the bills for the city. So that's why some are higher than others. So it's the estimated budget divided by the assessed property value. Okay. Also, they always round up because they want more money. And if they round down, they're going to be short. Okay, find the tax rate expressed as tax per $100 of assessed value for Harbor Town. That's a cool name. That, maybe it's on the harbor. That anticipates expenses of $95,590,000 and has property assessed at $3,868,758,500. Whew, that's a hard word to say. Hard number to say, sorry. So, to find the tax for every $100, first thing you're going to do is you're going to take the budget, so this is how much money the city needs, and you're going to divide it by the assessed value. And then because it's you want tax for every $100, you're actually going to multiply by 100. So before, when we saw the per 100, we divided by 100, but this one we're trying to get the percent, so we're going to actually multiply by 100. And that's going to give us $2.48 when we round up. So it's $2.48 for every $100 of assessed value. Now, if this was tax per $1,000, then here you would multiply by 1,000, right? If it was just per $1, well, you can multiply by 1, but that's not going to do anything. So for every $100, so let's say you have a home and you have assessed value. For every $100 of that assessed value, you're going to have to pay $2.48. Okay, and then the last section in chapter 20 is all about income taxes. So, income taxes, depending on the season, you may have just paid them or about to pay them, but you're all going to have to pay them at some point in your life. So, you can do some trivia with yourself here. When is the deadline to file income taxes? This is not true. It's usually the 15th of April, but if that falls on a weekend, then they will extend it to the Monday usually following that. How can you almost guarantee a refund at tax time? Well, that's to take more out. So the higher percentage you have withdrawn from your paychecks, the less you're going to have to pay at tax time. So if you take out more than you think you need, you should be okay. And there are different schools of thought around that. Some people think that you should take out way more, the highest percentage you can, so that, well, maybe not that you can, but a really high percentage, so that you're guaranteed to get money back. Other people say that you should take out a low or like a lower percentage or a normal percentage, because then you can invest that money and have it grow for you in your savings account. And then even if you have to pay back at tax time, at least you earn some interest from that money instead of the government earning the interest. So there's just some different schools of thought. It kind of depends on how well you budget or not. If you know that you're not a great budgeter, then you're not going to want to have to pay in come tax time, because maybe you won't have the money. So then maybe you do want to take out a higher percent. Okay, which federal agency collects your taxes? That's the IRS. Which law requires workers to contribute to Social Security and Medicare? That's all that FICA information. But we'll actually look at some of the laws there. The people you support financially, such as children, are called what? They are your dependents. What is the form called that is filled out by an employee providing the information needed? That's the W-4. So if you have a job right now, if you've ever had a job, oftentimes the first day you start, they'll make you fill out a W-4 form, and that lets the employee know how much you want taken out for taxes. What is the form an employer must provide each employee? that's the W-2. So come tax time, you'll get a W-2 from your employee that has all the information of what they collected. How long should tax records be kept? So it's at least 3 years, because that's how long they can audit for. So if it's been over 3 years, they can't audit you. But oftentimes people will say to hold on to it for 5 to 7 years just to be safe. Okay, so to find your taxable income, you first find the adjusted gross income. So that you're going to take your total income and you're going to subtract any expenses or deductions, and that gives you your gross income. Then you're going to total the deductions or choose the standard deduction. So the standard deduction did go up recently, but if your deductions are lower than the standard deduction, then just take the standard deduction. And then find the taxable income by taking the adjusted gross income minus any itemized or standard deductions, and then any more exemptions. Okay, so the Smiths' taxable income. I'm sure Will Smith's family makes more than this, but let's say that their adjusted gross income is $67,754. The itemized deductions are $11,345. And then each person gets an exemption of $3,700. So basically all you're going to do is take the adjusted gross income and subtract everything from that. So deductions, you're going to subtract what you can deduct from there. So that's the $11,345. So deduct kind of means subtract. And then everyone has an exemption of $3,700. So that's going to need to get multiplied by 4. So when you do that, you get $41,609. That's the taxable income for this family. So that's what they can tax. They can't tax you on the rest of it because they were deductions that you could take off for various reasons, and you had some exemptions. So different deductions may be like if you're in school, you can take off deductions for that. If you donated things to charity, you can take those off as a deduction as well. So those are the kind of things that they look at. Okay, so there are tax tables. Now the nice thing about your homework when you're doing this is there will be a little option to click on. It's like a little box symbol. It kind of looks like this next to the problem. You can click on and these will pop up if you need them. I think that's what it looks like actually. And it should give you the right tax tables. But this book, there's basically a book of tax tables because it's every possible income, right? This is just 39,000 to 40,000 to 41,000 to 42,000. So it's going to be pretty big because it's going to encompass all incomes. But let's find the tax owed by a married taxpayer filing separately. Okay, so you could either be married filing separately, single, or here's the other one, or head of household. So those are your options. So filing jointly means you're filing together. Filing separately means you're each doing your own. So taxable income is $39,478. Okay, so that's between $39,000 and $40,000, right? So I'm going to use these. Now notice here's the taxable income, at least this amount, but less than that amount. So we're looking at a range of numbers here. 39,478. I'm sorry, this is hard to see, but here's 39,450 to 39,500. So 39,478 is somewhere between those two numbers. So I'm going to use this line. And they are married filing separately. So I'm going to use this column. So it's going to be this number right here, which is 5663. So that's the tax owed. So this is one way to calculate your taxes, is just to use these tax tables. It kind of gives you a good idea of what your income tax would be. If they file jointly, then it would be 4,999, I think that says. Hard to see. Okay, so another thing that you can do is to use the tax computation worksheet to calculate the income tax. So there's one way, is to use tax tables. Another way is to use the computation sheet. So here are instructions right here, but it's going to walk you through that on the sheet. So I think I have this on this paper, so let me pull that up. It's on here. Aha. Okay, so here's the tax computation worksheet. So Section A, you use this if you're single, married filing jointly, married filing separately, head of household. So here are the 4 different options. So if we go back to our problem, hey, where'd you go? Okay, so we have taxable income of $112,418 for a married taxpayer filing jointly. Okay. So married filing jointly, so I'm going to use this one right here. And the amount, let's go back and look at the amount, was $112,418. So if you look here, here's at least 100,000, but not over 151,000. So I'm going to use that line right there. So you're going to put that amount right here. See if this lets me use the pen on here. It's not going to let me do it. Okay. Oh, maybe if I click off of that. I guess it'll let me right here. Okay, so we'll try this. Okay, so we've got 112,000. $418. All right, it doesn't want to let me write. All right, that's okay. So I'll just tell you. So $112,418. Now right here it tells you what to do. So it says multiply that number by 0.25. Okay, so you do the multiplication, and then whatever you get there, that's the number that goes here. And then there's a subtraction amount, so it tells you what to subtract. So it says subtract $8,412.50. And then it actually tells you subtract D for me, and here's your answer. And that's the result that you're going to put in your tax forms. So if you go back here, here's the calculations. You get $19,692. So that's a way to estimate the income taxes you're going to owe. You can either use the tax computation worksheet, which I just showed you, or here, you can use the tax tables as well. And they should be roughly the same, but they could be slightly different. Okay, these tax tables are in your textbook. They also should, like I said before, show up on problems where you will need them. I want to just kind of show you a 1040EZ in case you're not familiar with this. So let me show you some different forms. So come tax time, so in January, they have until the end of January to send out your information, your W-2 and your 1099s and those sorts of forms. There's a lot of different numbers involved here, but most of you will get a W-2, and you'll get one from each employer you had during that year. So it will look something like this with the amount. This is your gross income, so that's not what you actually saw, right? That was before they took out all the taxes. Here's the tax they withheld, Social Security, Medicare, all that stuff that's taken out. And it'll have your employer, it'll have your name, your Social Security number, etc. And then if you have money in the bank where you've earned interest, and sometimes if you haven't earned enough interest, so if you've only earned like 10 cents this whole year in interest, you're probably not going to get one of these forms. So it has to be above a certain amount. But so this person will get what's called a 1099 INT, so that's interest income. So that's any interest you earned, most likely from a bank account. So this person got $43. So you'll get one of those too, and you'll have to plug that in when you're doing your taxes. So some of you will fill out a 1040, some of you a 1040 EZ. This is basically what you fill out in the end. If you've done TurboTax, you've done it probably electronically. You've done it, and then if you're going to send it in, oftentimes you'll have to print this out and fill some stuff in. But a 1040 EZ is for single and joint filers with no dependents. So easy, think of it as being easy. So you don't have a lot of additional entries you need to put in there. If you own a home or if you have kids, it gets a little more complicated. So then you either want to have someone prepare it for you, like an accountant, or you're going to use a different, well, but you're going to use a different form even if you prepare it yourself or they prepare it for you, but you most likely won't be able to use an EZ. But this is kind of an example of what you might see. And then it tells you if you get a refund or if you owe, and you'll have to sign and send this in. And then you don't have to fill out this bottom part. That's just if someone does it for you. So if you have an accountant, then they'll put their information here, so that if you get audited, so if they come and take a look back at your records, they will audit. They'll talk to them as well. All right, so, and then you'll have to attach your W-2 when you send it in. All right, so that's pretty much it for the math portion of calculating the taxes. If you have any questions or comments, I welcome those, so feel free to email or post in our discussion board. Have a wonderful day.